It's quite easy to determine the direction of the stock market. If central banks print money and the global monetary supply increases, we could see stocks rising. If central banks decide to print less money or even contract the monetary supply, stocks will fall. End of story. You came here for the truth, so let me unveil that for you. Today we're going to look at several factors surrounding the financial system. Today I think it's absolutely ludicrous that this information needs to be covered because people should know it by now. Anybody who has been paying attention to the financial markets knows what I'm about to show you. All I'm doing is updating you. I'm giving you the latest data, but the actual knowledge of it should be persistent all throughout. You're looking at the asset quilt of total returns. This comes from Bank of America. We are seeing this from 2000 all the way up until 2019. It's very interesting. Might be hard for you to see on your screen here, but just wanted to show you. Here's the year 2000. Here's the year 2019. And we're just comparing the different assets. All right. So you look over the years, what has been the best performers. You're seeing commodities doing very well. Obviously, oil had risen quite a bit there. Looking at the S&P 500, 13.7%. It doesn't give us a day as to when this was from, but I assume it's relatively recent, showing you year-to-date returns. You can just compare all the asset classes, and looking back at 2018, obviously everything did very, very bad. The only thing here, cash, 1.8%. Basically, US dollar did well. Everything else tanked. I believe it was 93% of all assets fell in 2018. So big difference from what we saw back in 2017, 2019. It remains to be seen. So far, it has obviously done well considering what happened in the fourth quarter of 2018, but we'll see if it can achieve much higher prices in the near future. Year-to-date flows to debt and equity funds. It's interesting because we are seeing this persistent all throughout 2019, actually going back from about September, October timeframe of 2018 into 2019. Money's been leaving. This is crazy because I don't think it's ever been this persistent for such a long stretch. It doesn't really add up when you think about it. This is US equity in the negative. That means money is leaving equities. How is that possible when you're watching the stock market rising for this period of time? So obviously through October into December it was tanking, and then from the end of December up until present the stocks have performed very well. However, if you look at the actual fund flows given to us by the EPFR, who tracks all that data, all that information is there if you want to check it out. It is something that I think people do not understand. If you just look into it, you understand what's really going on, but most people simply don't care. This just shows you Europe equity and US equity having a very negative time, that's for sure. And you compare that to all these others, even emerging market debt has done well this year in comparison. I mean, it's crazy to see what this real stock market chaos has done. Nobody knows what the future has in store. Tech fund flows have been very subdued year to date, and you're just looking at that here. It might be difficult to understand this chart, but you're looking at from 2010 up until 2019 how it has looked throughout the year, and obviously 2017 rocketing higher for tech stocks. 2018 was doing pretty well overall. Obviously January had some troubles, but then towards the end of the year it started to tank. Now in 2019 it hasn't looked as well either, so it's showing us now that this has been a time in which money is fleeing in order to gain safety. That's what they're doing. They're not taking as big of risks for some of these investors. Anyway, we have seen the growth of certain derivative products, but that's a whole different ballgame. I just wanted to show you this because the tech stocks are considered to be the holy grail of what we should be investing in. Active versus passive equity flows since 2009, just showing you obviously over the years, particularly since the financial crisis, money has been leaving active funds and it has been going into passive. So the ETFs have been very popular, and I don't think a lot of people understand this because ETFs had been prior to, if we're looking at back in this time frame, ETFs were basically in their infancy, and now today they are extremely popular. So what's going to happen when we have a recession? Nobody really knows, and the real problem is going to be liquidity, and a lot of individuals are going to be up in arms when they have trouble selling. I've said this on hundreds and hundreds of occasions, but stocks can rise if central banks print more money, and stocks will fall if central banks do not. Now, this tells us here that even in the recent past, this has been entirely correlated. So let's compare the two. The global monetary supply is the red line, global stocks is the green line, and you're seeing what happened from September to the end of December with the global stocks tanking. Now, that happens to correlate somewhat here. As you can see, global monetary supply starts to contract, but as we get toward December, that starts to increase, and it does so for several months, and there's no way to deny this. And you're seeing that the global stock market obviously came up during this period of time, and it just so happens that we are seeing another correlation forming right here as the last month basically stocks have been in this turmoil. Has it been related to the geopolitical issues? Has it been this or that? Or is it the global monetary supply once again? Now, we are only looking at the last several months. If you compare this from 2009 up until present, they move in lockstep. You see, wherever they go, they move together for the most part. And it's pretty interesting to see this time and time and time again, to see these two correlated, and the public doesn't know about it. I'm not talking about the general public. I'm talking about those investors, the people who believe that they know exactly what's going on, those in the financial industry. They do not see this correlation, and I think by now we should all have it figured out. Central banks completely control everything that's happening to the stock market. They are making it go up, they are making it go down. They are the ones that make the sun go up in the morning, I assure you. I really don't even know why I have to continuously cover this, because my regular subscribers, they know this. They know this information. They've seen it 100 times before. All I'm really doing here is giving you an update. But consistently, I see out there that individuals do not understand it, and it just boggles my mind. That's all I'm trying to say. It's just really surprising to me now in 2019, they haven't figured it out yet. Inflation fears. The Fed fears over low inflation have been mounting, with Powell recently calling it, quote, one of the major challenges of our time. Now, if you remember this quote here from Jerome Powell, he suggested that low inflation is bad, and they're trying to achieve a 2% inflation rate, and they do so with the core PCE number, which basically is completely fraudulent, has nothing to do with reality, but that's the number that they use. The question I have is low inflation really bad? Do you care if the food that you go to buy at the store has not increased? What about your energy prices? Do you care if you're going to pay the same amount for your gas bill you did this year as you will next year? I'll tell you right now, I wouldn't be too upset, but this is what they want. This is done purposely so that they can erode the value of the debt that they owe. That's unfortunate for people because it makes them speculate, and people don't see it, but this is where we're at today. This forces individuals to be speculators instead of savers, and they do so on such a regular basis that it's almost as if having a quote-unquote low inflation, although they're using the wrong metrics, it's somehow bad. It's just unfortunate to see it. And I just wanted to finish off with this. Parking lots in parts of Alabama are filling up with Mercedes SUVs. You can read the issue here. They're saying that they need to use some other lots and so on. But what this really tells me is what's going on with the car manufacturers is being hidden from the public. We are seeing thousands and thousands of these cars lined up in every part of the United States. We're talking about millions of cars that are sitting there unsold. And this is not something that's normal. I hear this all the time that, oh, don't worry, we just got some extra inventory here, we're going to sell it, but this happened and that happened, so don't worry, it's just going to take an extra month or two. The fact that they keep it in lots somewhere, or the fact that they are selling it at a discount to the rental places, that to me shows the weakness, and you just have to keep your eyes open and see it for yourself. That's it for this video. If you found it informative, please give me a thumbs up. When you give me a like on this video, you're supporting me, supporting this channel and the truth, so I do appreciate that very much. If you want want the financial education you weren't taught in school, these 2 books have everything you need: foundation, history, asset classes, all the details. Check it out, the link in the description. If you want the audiobook, that's available at themoneygps.com. If you want to find out about the unsold cars, if you want to find out about the nearly 7,000 store closures, all the details are located in this video. Click on it and I will see you there.